Today, we're unpacking a really tense drama that's playing out right now between these super optimistic financial markets and, well, the world's most powerful central banks. This is a story of conflicting signals, wildly different paths, and a global economy that feels like it's teetering on a knife's edge.
Okay, so let's just dive right in. On one side, you have the market narrative, right? Global stock markets are hitting all-time highs, and it's all fueled by this belief that we've tamed inflation without a major recession, the perfect soft landing. But if you're a central banker, you're seeing a much, much more dangerous and uncertain path ahead. For them, this isn't a victory lap. It's a fragile, really high-stakes gamble. So, what's at the heart of this whole conflict? Well, it all comes down to one incredibly powerful tool: the benchmark interest rate. The easiest way to think of it is as the cost of money for an entire economy. A central bank basically acts as the economy's guardian. Now, unlike a regular bank, it's not trying to make a profit. Its job is to manage monetary policy, all to keep prices stable and make sure economic growth stays on a steady track. They are the ultimate financial regulator.
And this creates a huge ripple effect. See, when a central bank cuts its benchmark rate, it suddenly becomes cheaper for commercial banks to borrow money. And guess what? They pass those savings on, lowering interest rates for things like car loans, business expansions, and, yep, credit cards. The whole goal is to make money cheaper for everyone, which encourages us all to spend and helps boost the economy.
But it is an incredibly delicate tightrope walk. I mean, think about it. If they cut rates too soon or way too fast, inflation could come roaring back, undoing years of painful work. But if they wait too long, those high borrowing costs could completely choke off growth and trigger a really deep recession.
And this, right here, is where the story gets really interesting. Because far from acting in unison, the world's major central banks are now on starkly different paths. Each one is reacting to its own unique economic pressures. Now, you might expect key allies to kind of move in lockstep, but that is not what's happening at all. The US is holding its rate higher, while the UK and Australia have already started to cut. There's no single global strategy here. And when you dig into the details, you can really see that divergence. The U.S. Federal Reserve is holding firm, just watching this mixed bag of economic data. The Bank of England just made a super contentious cut, even though it expects inflation to rise in the short term. And then there's Australia, cutting cautiously, trying to protect its strong jobs market. Three banks, three very, very different stories.
Over in the US, the Federal Reserve is holding its rate steady pretty much because the economic data is sending completely mixed signals. It's like trying to navigate a ship in a huge storm with a compass that's just spinning wildly. So on one hand, you've got this really strong headline number. Real GDP grew at an annual rate of 3% in the second quarter. This is exactly the kind of data that fuels the market's optimism for that perfect soft landing. But on the other hand, the labor market is softening, and pretty significantly. July saw only 73,000 jobs added, which was way below what anyone expected, and the unemployment rate actually ticked up. This weakness is exactly why the Fed is being so cautious and is so hesitant to just declare victory. Meanwhile, the Bank of England's recent rate cut was an incredibly contentious decision. I mean, the vote was a razor-thin 5-4. They're cutting rates even as they forecast inflation will tick up again. It's basically a high-stakes gamble that the underlying price pressures are going to continue to fall in the long run. And then Australia offers this third path. Their central bank has what's called a dual mandate, meaning they have to balance fighting inflation with maintaining full employment. So they're cutting rates cautiously to preserve their strong labor market, which could be a potential model for a true soft landing that doesn't sacrifice jobs.
So what does all this high-level global drama actually mean for your personal finances? Well, it turns out quite a lot. If you have debt with a variable rate, like credit cards and home equity lines of credit, a central bank rate cut brings almost immediate relief. Those rates are directly tied to the benchmark. For mortgages, the effect is a little more indirect. It's linked to bond yields. But a central bank's policy direction is still the most powerful signal for where those rates are headed. And in the housing market, this unusual cycle of rate hikes has created something called a lock-in effect. Millions of homeowners who locked in those ultra-low mortgage rates a few years back are now, understandably, unwilling to sell and take on a new loan at a much higher rate. This is trapping the supply of homes for sale, which, in turn, keeps prices stubbornly high. And this is all happening at a time when the consumer debt burden has reached a staggering, truly unprecedented level. Right now, U.S. household debt stands at over $18 trillion. Now, mortgages make up the biggest piece of that pie, sure, but the real story here is in the details. Credit card debt has just ballooned to over $1.2 trillion, and it's the rapid growth and the rising number of late payments in this high-interest category that's becoming a major concern for the economy's stability. Just listen to this one statistic. It reveals the fragile reality for millions of households. It is a stark, sobering contrast to the roaring optimism we're seeing in the stock market, and it shows that for a lot of people, this so-called soft landing hasn't landed at all. So, let's zoom back out and consider the final, really uncertain chapter of this story. Where do we go from here? It is so important to remember that this soft landing isn't a guarantee, it's a bet. The markets are betting that central banks can perfectly execute that tightrope walk we talked about. But it's a bet that could easily be proven wrong by just one bad inflation report or one unexpected economic shock. The path forward remains so divergent, and it's clouded by major uncertainties. I mean, all eyes are on the upcoming Jackson Hole Symposium for any clues from the Fed. In the UK, the big question is whether their rate cut will ignite a whole new wave of inflation. And of course, looming over everything are political risks, like potential new US tariffs that could throw a giant wrench in everyone's plans. And that leaves us with a final, provocative thought to consider. The market is betting heavily, betting that these central bank acrobats will make it to the other side. But as we watch them walk this tightrope, balancing inflation and recession, the real question we should be asking is, what happens if they fall? Is there a safety net?